Welcome to our deep dive. Today we are jumping straight into the Plug Power third quarter 2025 earnings call. And this was a really high stakes moment defined by some massive strategic changes and a huge internal push for a financial cleanup.
It really was. This was a results print that had this distinct duality to it.
Duality, how so?
Well, on one hand, you had a headline miss on revenue, which, suggests things are still tough out there. But on the other hand, a crucial win on the balance sheet, on cash burn. And that drove an immediate, really positive market response.
Okay, let's unpack that market reaction because it was pretty unusual. Give us the core financial snapshot that defined the quarter.
Sure. So starting with the raw numbers, the company reported an adjusted EPS loss of 12 cents. That actually beat the consensus expectation of a 13-cent loss. So a small win there.
A small win, okay. But the revenue?
That's where it got tricky. Revenue came in light at $177 million, missing the expected $187 million. If you look at that top line, it's only about 1% to 2% year-over-year growth. Basically flat.
Right. A near flat quarter on revenue. And yet the stock jumps almost 12% in after-hours trading. That's a powerful signal. It suggests investors were looking right past that revenue number.
Completely past it. They were focused on the deep operational and financial actions management took this quarter.
And this was all branded under that internal initiative, Project Quantum Leap.
That's the one. And the positive sentiment, it stemmed almost entirely from the tangible progress they made on profitability and liquidity.
So let's get into those metrics. How do they actually demonstrate this shift? Because flat revenue and a 12% stock bump, something big had to happen elsewhere.
It was all about cash conservation. The operating cash they used went down by over 50%.
50%. Sequentially or year over year?
Both. Over 50% sequentially and year over year. It ended the quarter at about $90 million. That kind of reduction in cash burn is substantial. It addresses, one of the biggest concerns analysts have had for years.
Okay, so cash burn is way down. What about margins?
The adjusted gross loss narrowed dramatically. It came in at around $37 million, which is a huge improvement from the, $86 million loss they had in the previous quarter.
That is a big improvement. But you said adjusted gross loss. I saw the GAAP number was much higher, closer to $120 million. So for you listening, what's behind that big gap? Why is the official GAAP number still so messy?
That gap is the financial cleanup in action. It's the whole point of Project Quantum Leap. The quarter included these huge non-cash charges totaling around $226 million.
And those are for
resolving legacy issues, writing off assets that weren't performing, basically just simplifying the entire business structure. They're taking the accounting pain right now to get all the old messy stuff off the books.
So they're clearing the decks. That makes sense. But the real game changer here, the thing that I think really moved the needle, was the liquidity catalyst they announced.
Absolutely. This was the key lever. It instantly de-risked the balance sheet. Management announced they're going to monetize contracted electricity rights in New York and one other location. And this is expected to generate, in their words, over $275 million in cash.
Okay, wait, I need you to clarify that. What exactly are contracted electricity rights and why are they suddenly worth $275 million?
Think of it like this. PLUG years ago secured these cheap long-term electricity contracts. They did it for their own future green hydrogen plants. But now that area, especially upstate New York, is seeing this massive surge in demand from data centers, the whole AI build-out.
So the buyer is a data center operator, and PLUG is basically selling their spot in line for cheap power.
That's it, exactly. They are permanently transferring the right to access that low-cost power. The deal is expected to close mid-first quarter of 2026. For PLUG, it's a huge injection of capital without issuing more stock, and it really shows this new focus on capital allocation.
That is a fascinating trade-off. It really solidifies this idea that the focus is shifting away from those high-cost, long-term infrastructure projects. The market is rewarding financial discipline over taking on massive infrastructure risk.
And that leads directly into the single biggest strategic pivot of the quarter. Management announced they're suspending all activities tied to the DOE's $1.66 billion loan guarantee program.
Wow. Stepping away from $1.66 billion. That seems drastic. Right. How do you even justify that to investors? Doesn't that signal a lack of confidence in their own big projects?
That's the core tension, right? But management's argument was that they're redirecting that capital. They're moving it toward higher return opportunities that can deliver much faster. They're focusing on two things: hydrogen supply and backup power for data centers.
So instead of spending years and billions building their own stuff, which the DOE loan was for, they're changing how they get their hydrogen.
Precisely. They're now emphasizing a new global hydrogen supply agreement with a leading industrial gas company. It secures them competitively priced, long-term supply, it de-risks their whole supply chain, and lets them focus their own capital elsewhere.
A much less capital-intensive model. They're becoming more of a technology provider and less of an infrastructure developer.
Exactly. But it wasn't all just strategy shifts. The core tech business showed real strength. We have to remember, this company sells hardware. Janico electrolyzer revenue was $65 million. That's a 46% increase from just last quarter. Robust.
And on the leadership front, Jos Luis Crespo is taking over as CEO in March. He's inheriting a much cleaner ship.
He is. And the transition was handled well. Both he and the outgoing CEO stressed continuity. The market sees him as a known quantity, and these balance sheet actions are basically paving the way for him to succeed.
So let's connect all this to the bigger picture. With these actions in place, what are the forward-looking indicators we should all be watching? Has this changed the guidance?
It's made the guidance more credible. They reaffirmed the 2025 full-year revenue target of $700 million, and they're sticking with the goal of being gross margin neutral by the end of 2025. What's really interesting, though, is they advanced the goal for being IBIT positive.
IBIT positive.
Income before interest and taxes. Basically, the point where their core operations are officially profitable. They're now targeting the second half of 2026, and they even said it could be sooner.
We also heard some positive notes on their core business, the material handling segment.
Yeah, that's their foundational market. Forklifts, warehouse power, it's seeing renewed vigor. The big thing is the reinstatement of the investment tax credit, the ITC, for fuel cells. That policy certainty, plus their improved financials, is driving really strong 2026 conversations with their pedestal customers.
I mean, Amazon, Walmart?
Exactly. Management said these customers always liked the solution. They just needed to know the supplier was going to be around. Financial security was the missing piece.
Okay, now let's talk pipeline. That $8 billion electrolyzer funnel is always mentioned.
It's still there, and they say the quality has never been better. We're seeing real policy clarity in Europe with things like the Green Deal and RED III mandates. That's pushing huge industrial projects like the 3-gigawatt Allied Green Ammonia project closer to a final investment decision, or FID.
And FID, for you listening, is the point where the money is committed and the project is a go. So that pipeline is getting real.
Exactly. The visibility is key. And that brings us back to the data center opportunity.
Which feels like a really aggressive direct play on the whole AI boom.
It absolutely is. Their shift to providing backup power is a response to two trends. First, the insane power needs of AI in data centers. And second, tightening restrictions on diesel generators because of emissions. Hydrogen offers a zero-emission solution that provides days of backup, not just hours. It's a huge potential market.
So they're swapping out a risky, slow market for a booming, high-margin, hardware-focused market.
That's the pivot. And that brings us to the segment where we explore some of the higher risk, higher reward scenarios this all unlocks. Now, this is not financial advice, but we are putting on our hedge fund analyst hat and pitching an outrageous but plausible trade idea.
All right, what's the thesis?
The thesis is all about execution. We are betting that the company successfully executes on this new, refined capital strategy. A strategy that favors high-margin hardware like electrolyzers and data center backup over those slow, capital-intensive projects they just paused. The risk profile has changed.
And what's the specific, highly leveraged way to play that story?
The pitch. A leveraged option strategy targeting a price move above $4 a share by mid-2026.
Okay.
Now, this trade is totally contingent on two specific near-term catalysts playing out perfectly.
Okay, what are they?
First, the successful close of that $275 million electricity rights deal in Q1 2026. That transaction has to happen. It validates the new discipline. Second, the announcement of at least 2 meaningful data center backup contracts. They have to prove that this new focus area has real legs.
So this is an execution trade. You're betting that their new discipline, plus AI-driven power demand, creates a real inflection point. If they hit those two wickets, the whole narrative changes, right? From a cash-burning developer to a disciplined technology supplier.
Precisely. They bought themselves time with these actions. The market now just needs to see them use it wisely.
Okay, so let's recap the most critical elements for you. This quarter was not defined by the top-line miss. It was defined by an EPS beat and a massive balance sheet de-risking through that $275 million monetization and the huge drop in cash burn. They are strategically trading large infrastructure risk for disciplined capital allocation in faster-growing markets like data center backup.
The key takeaway for you is the foundational shift. The incoming CEO has a much stronger foundation to build on. But the real test, is converting that massive $8 billion electrolyzer funnel and proving that data centers can become a meaningful, sustainable business.
And that brings us to our final provocative thought for you to chew on. Management sees global policy aligning to drive these big projects to a final investment decision in 2026. What happens if that $8 billion funnel converts much faster than anyone anticipates? What if that pushes the goal of being IBIT positive even earlier than mid-2026? That scenario, that acceleration, coupled with a de-risked balance sheet, well, that's what could fundamentally re-rate this stock overnight.